Good morning and welcome to the live series Straight Off the Bat, a show that covers the need to revive and survive and adapt to the new normal of COVID-19. Join us on Thursdays as we speak to individuals across multiple industries who will help you understand financial literacy and education. Today, we are joined by our guest, Philip Williams. He's an assistant vice president of fixed income investments for one of the major investment companies in Trinidad and Tobago. He's also the executive chairman and founder of Fill the Gap, which has been in existence since 2016. Today, we'll be covering how to make sense of your money. I'm your host, Pauline Joseph, and I have so many questions about money. Don't let me hog Philip today because I want to find out if I should buy a new car or not, and I want him to tell me. So
I remember I would go to my grandmother's house every Saturday and she would give me $5. Now you have to think about this in context. $5, then $10 for a little boy like me, it meant no, I am rolling in it. So I would save my money every Saturday. Now, I'm the youngest of 3 siblings, and so one is 10 years older than me, the other is 4 years. I would have sometimes more money. They would spend their allowance, so sometimes they may borrow money from me. They would pay back, but that was like my first experience with money. Very, very first experience, and it's interesting that you ask that because the things that, the relationship you have with money, how your thoughts are shaped, is really from your environment, maybe from your parents. Hopefully you learn some stuff at school. But that was my first experience with money, saving money for snacks, to go to the grocery, to stock up. That was my first experience.
That is insane. For those who may not know, I literally just met Philip, so I didn't know this story was going to come. But we had a session with Tanya 2 weeks ago, and I said the exact same thing. My snacks was different. Mine was Bigfoot. Recently they have spicy, but Bigfoot is lashing. And as soon as I got, $1, $1 back then used to stretch further. The first thing I did was snacks. But you did better than me. You saved to go buy it. I just went, as soon as I got it, bam, it was too hot for my hand. I was like, oh my gosh, I need to spend this.
I have to say, because my parents, they wouldn't buy. It's only so much snacks you would get when they go to the grocery. My snacks would run out. So yeah, that's a real life true story. That's it right there. That's it right. That was the beginning of money. My journey with money started with snacks.
Yeah, the new generation wouldn't understand that struggle, and I want parents out there to let them know. I'm sure they know that. Let them know already. Anyways, so we are in a space where it is difficult for a lot of folks to understand how to go through these challenging times, and it's easy for folks to be able to interchange the word savings and investment, right? Because some of us may not have had that conversation with our parents to say, this is what you need to do with your money. So for those out there, when I say those out there, I mean really me. What is the difference between savings and investment?
So first of all, listen, good question. Let's start with what investing is. And I think let's start with the word investment. And I feel as though the minute people hear the word investment, our mind goes to a particular space where only for the wealthy, it's for the big businessman, it's the person with the fancy degree. And if anybody has, if you have pen and paper out there, there's some things that you might want to jot down. I want to let you know you can invest, right? You just have to believe in yourself. You can invest. And that is the way to grow your wealth. So investing is really taking the money that you work so hard for and getting that money to work for you. So it's putting it into an asset. And I know the question might be, Phil, what kind of asset? And we're going to get to that in this discussion because you hear the words like stocks and bonds and mutual funds. And what does that really mean? We're going to break all of that down. But I want you to know that you can invest, and that is the way to grow your wealth. That is the step you need to take to position yourself for financial success, for financial freedom. Keeping in mind your financial situation, is not someone else's financial situation. So you need to focus on you. But so that's what investing is, very simply taking your hard-earned money, putting it in an asset, putting it somewhere for, to get it working for you. Very different than saving. So sometimes the word savings and investing are used interchangeably. And the thing is, yes, it's putting money aside for a future date to get a return, but there's a vast difference. And the difference is, with investing, you are more looking way down the road. You're looking far down. It's more long-term oriented versus saving, which is near-term, right? So it's never ever confuse saving and investing. Two very, very important vehicles. But that was like my first experience with money. Very, very first experience.
I've been in banking since I was a teenager.
So if you're just joining us, we're here with Philip to have a discussion around investment from a local perspective, because we get so many bombarded informations from the United States and other parts of the world. Let's have the local conversation. Yes, Desiree, yum, hashtag Bigfoot, you know it is, you understand me. And for those who are not aware of what Bankers Association is, just follow that button and you'll get all the notifications when we go live on these sessions. So, Philip, you had a discussion around long-term versus short-term, and I think that's such an important thing for us to discuss, because we are living longer. We are more connected, so we think that the world is, going to disappear at some point in time. But our connectivity is bringing this level of information that may not necessarily reflect the world, because the world is in a position where we are living much longer than we've ever had in the history of time. So as someone who may be in their 20s, you're thinking, and then when I say in 20s, I'm thinking, I'll live this life, whatever. And you're not necessarily thinking about what 60, 70 looks like. So could you break down the idea of short-term versus long-term with your money?
Yeah, sure. So short-term will be anything really short, less than a year. So let's say 1 to 3 years, that's short. Ultra short is 1 year. Once you start to move beyond that 3-year space, and it's money that you are putting aside, then you really have to start thinking about, well, okay, I need to put this money to work in a long-term asset that's going to work for me. So short-term, as I said, 1 to 3 years, medium 3 to 5, anything past 5 years going towards 10 years now, that would be long term. And it's I like that you mentioned going out to 60, people living longer. Listen, trust me, I do get it, because I was once 20, 25, and the things that you could be thinking about then is that, listen, it seems far-fetched. It doesn't seem far-fetched that one day you're not going to be working. It does not seem far-fetched that you need to think about retirement. And that is something which is a long-term goal. And it doesn't even necessarily have to be retirement, because I know millennials or young people don't like to hear that word. So it may mean when you determine that, listen, I want to leave the workforce because I'm becoming a consultant, but at some point when your earning capacity is not where it was before, or you just want to have the luxury to chill out. Some people want to retire earlier. Somebody may want to retire at 40, 50.
So if you're just joining us, we're here with Philip having a discussion about investment. We're going to go on a short break, and on our return, we're going to have a conversation on basic, simple investment opportunities. So we'll see you on the other side. welcome back to Straight Off the Bat. We're here with Philip having a conversation about investment opportunities because it can be a bit overwhelming, as Melanie has in the comments, being afraid of equity products. And like, girl, I don't even know what equity products mean. So that's why we have Philip here to have that conversation. So let's ask Philip, as someone who's not, I hear about things like the Robinhood app and stock markets and all these different things, but don't necessarily understand. And you mentioned earlier about, you could start with as small as $100. If I do have $100 and I want to start investing in something, where do I start? Where does the process begin?
Very simple. So I want you to know that there are two ways that a company can raise money. So when you hear equity, interchange equity is stocks, right? So the two ways that a company can raise money is either by saying, listen, you know what? I'm going to give you some ownership in this company. You're going to give me some money. And as a result, now you have some rights to share any profits, right? The other way they can do that is saying, listen, can you give me a loan so that I can expand the business and buy the stuff that I need to buy, and I'll pay you back at a certain time. In the big finance world, the complicated term for that is a bond. A bond is really a contractual agreement to pay back because there's a cost to borrow. So the two traditional types of investment vehicles are stocks and bonds, right? So a stock, as I said, is really ownership in a company. They're raising capital so that they can now go on, do the business and generate profits to pay investors a return. So stocks and bonds. So if that wasn't clear, you could still stop and say, Phil, what exactly does that mean? But when you hear stocks, just think of equity. When you hear bonds, just think of a gigantic loan. And same way that you're going to go to the bank to get a loan, it's the same way corporations and governments have to borrow money to do different things. Governments borrow money to build roads, to pay salaries, for infrastructure. It just depends. Now, taking these two traditional types of investments, the stocks or the equity. So let's just say stocks, right? So if you hear stocks, that means equity. And bonds, these two traditional type of investments. An investment company really will pool these investments together in what is known as a mutual fund. So you asked the question of, well, Phil, what's the best one of the best places to start off for a newbie investor? A newcomer investor, a good place to start off is in a mutual fund. And I can explain why. But just let me explain what a mutual fund is. Think about a basket of investments, a basket of stocks and bonds, or sometimes a basket of just stocks or a basket of just bonds. Pool together, all of us pooling our money together, and someone is managing that on our behalf. We pay them a fee and we get the returns from stocks, the stocks and the bonds. Now, you might say, well, Phil, how does a stock earn money, or how does a bond generate money? A stock will earn money now because if the company is doing well and the profits are increasing, people are going to want to buy this stock and the company can pay a dividend. So you earn either via a dividend, and once a lot of people want to buy the stock, it pushes the price of your stock up. So that's the two ways that you can earn from stocks. Capital appreciation, that's the price going up. So you bought at $1, now it's $1.50. The stock price has appreciated. The company decides they're going to pay you some of the profits in a dividend, you get some money there. So you earn that way through stocks. With a bond, how you earn is just straight the contractual agreement to pay that interest because there's a cost to borrow. Stocks and bonds. Now, mutual fund, as I said, is a basket. It's bundled together, all of these assets combined together. And think of it, as I said, so they're big investment companies. Some of the banks have mutual funds. You would know some of the mutual funds. There are different mutual funds in Trinidad and Tobago, but it really is a basket of stocks and bonds. And based on the earnings from the asset in this basket, whether it's capital appreciation, dividends, interest, that is how an investor is going to get paid. So if you entered into, if you bought into a mutual fund, that, as I said, there's some of them on our market that is as little as $100. I'll give you an example, a real life example. A mutual fund. So you can have a mutual fund that is just stocks. You could have one that's just more like fixed income bonds, or you could have a blended, so it's stocks and bonds, a more balanced approach, right? A balanced fund gives you the best of the both worlds. It's more moderate, it's not as aggressive. A straight 100% equity fund that's just stocks is a more aggressive because your earning potential is a lot greater. The more stocks that you have, the greater your potential is to earn. Once you're investing and you're thinking long term, you're protecting yourself, you're protecting the purchasing power of your dollar, which kind of gets back to saving, which you have less protection there because you're earning less. There's less risk, but there's also risk. So and I want you to know there's risk in not taking risk, particularly for a young person. So I know some people that are ultra conservative, and I don't want to lose anything. I don't want to lose anything on my principal. I just want to put my money, park it up. And that's fine. I think that's a good place, at least if you know that about yourself. The other thing that you would need to understand with that is that there's huge risk in not taking risk, particularly when you're a young person, because you cheat yourself or you rob yourself. You don't give yourself that opportunity to have the long-term growth and have access via the stock market or via a growth type mutual fund, where you can, position yourself for growth to achieve goals.
I think that's a great point that has answered Radhika's question around people who may not be risk tolerant. I think, millennials, we are a bit younger, so we have a little bit more leeway. I want to ask Melanie's question, her very first question, because she was here very early. And I want to ask her question around her daughter's university fees, because I'm sure a lot of parents can relate. So she's asking, I need to pay for my daughter's university fees, but do not want to touch my various nest eggs. How do I balance both?
That's a good question. I mean, so not touching your nest egg, but the thing about it is if you have the fees to pay, you have the fees to pay. So I think in a situation like that is evaluating exactly what you have in your nest egg. Also have to be mindful of the fact that if it is you need these funds within a year, you don't want to be putting that money at risk in stocks or in a fund that is going to fluctuate, and then now the principal could be a little lower than you anticipated at the end of the year, and you don't have the time to wait for it to recoup the losses. I hope that answers it.
Well, our comment section is proof that our audience is way smarter than I could ever aspire to be, because some of these questions I'm like, what? But I'm going to ask them. Rahika seems to be a bit risk adverse because she wants to know, how often should a mutual fund investor review their portfolio to determine if changes are necessary?
Very good question. Very good question. So, I mean, somebody might be ultra meticulous and you might look at the price. So your mutual fund is mandated to put out the price every day. Most mutual funds, price will be in the papers or it's going to be on the website somewhere. You could check that every day. Chances are it's not going to have any drastic change, but certainly, for the very least, on a quarterly basis, you want to look and see how the fund has performed over a quarter. If you don't have the quarterly information, definitely semi-annually, and it should never be, well, definitely you want to know what happens at the end of the year. But I will say a good gauge, a good benchmark, the quarterly review to see, well, okay, mutual fund is performing this way, and ask the reason why. So not because the mutual fund is not performing the way you expect it to perform. You might want to get the background information as to why the fund is performing that way. But things are not that great in the economy. Stock market is down. So, you may want to either A, hold strain, or B, say, I'm going to take on more risk. It just depends. But certainly quarterly is a good time. Quarterly review is a good benchmark to monitor your investments and see if any changes need to be made and if you are on track to achieving the goals that you would like to achieve. You are going to be well on your route to financial success. Phil, the gap is here for you. So all of the questions that said we didn't get answered, investment advice, personal finance coaching, Phil, the gap is here for you. So even if we didn't get it done, we didn't get it covered here, please, as I said, visit the page, visit the handle, and you can always drop a DM, and I'm happy to assist and happy to answer your questions. You can invest, you can grow your wealth.
Thank you so much, Philip. Such a great session. I learned a lot. I will also be sliding into your DMs. And thanks again for the session. And for those who don't know what this is, Straight Off the Bat live show that is aired on Thursdays on Bankers Association of Trinidad Tobago Facebook page, as well as our YouTube channel, where we cover all things financial literacy and education. Because during these times, we really need to figure out how to do more than survive. Some of us are surviving, some of us trying to figure stuff out, and that's where we want to do these sessions for you. So the least you can do is follow that, because it's our best price, guys. This is free, you know what I mean? Anyways, see you again in our next session. Don't forget to sanitize and mask up, and we are all hopeful that we will come out on this the other side. So see you soon, everybody. Bye.